So in this video, I'm going to talk about another financial market, the stock market. So if you still remember this graph when I was talking about the financial system, so money flows from the supply side to the demand side, right? Again, who are on the supply side? Individual savers, institutional savers. Who are on the demand side of money? Individual borrowers and the investors, right? So there's several channels for money to flow from the supply side to demand side. The money can flow through financial intermediaries, for example, commercial banks and the mutual funds. Or money can also flow from the supply side to demand side through financial market. So I have talked about a bond market in my last set of video clips. So for example, if the city of Houston, right? So let me open Google Maps first. And let's go to Houston. So here, you see this loop of highway, right? Sam Houston Highway. So this is a tollway. So if the city of Houston decides to build another loop somewhere, maybe here, build another outer loop to solve the traffic problem, right? So building highway is very costly. It can easily cost city government billions of US dollars. But the city may not have $20 billion cash, for example, available to begin the construction of a new highway. So in this case, the city government can borrow money by issuing bonds here. So the city issues bonds. So individual bond investors, right? They buy bonds issued by the city government. In this process, money flows from bond investors to this borrower, particular borrower, the Houston city government. So in addition to government, corporations, they can also borrow money by issuing bonds. So remember the example I mentioned for Disney. If Disney wants to build another theme park in Orlando, Florida, right? This project is going to require, so for example, $10 billion down payment. But Disney may not be able to have $10 billion cash immediately. So in this case, Disney can borrow or finance this project, 10 billion US dollars, right? By selling or issuing corporate bonds, Disney bonds, right? So for example, if Disney wants to borrow $10 billion from the general public, bond investors for how long? For 5 years. And to give potential investors some incentive to buy Disney bonds. So Disney may offer, for example, 1% or 2% annual coupon rate. Remember what's coupon rate? Essentially, that's just annual interest rate. But in the bond market, it's called a coupon rate. Okay, so some potential investors, right? They may have other options. They can either put their money in a savings account. They can invest in the stock market. They can invest in the real estate market. They can invest in the foreign exchange market. But they may view buying Disney bonds more appealing. So they may buy Disney bonds. So 5-year bond with 2% annual coupon rate, right? And if you remember, bond investment involves a particular kind of risk called a credit risk, right? Bond issuer, that means the party who borrows money from the public, general public, by issuing bonds, they may not be able to fulfill all those promises written on the bond certificate. So for example, I'm going to pay you back once this piece of paper expires. But in the end, this borrower, either Disney or any government, right, may not be able to pay that money back. And in addition, bond issuers, they may not be able to fulfill the coupon payment promise. So for example, if they promise to pay you 2% annual coupon payment, right? but for some reason they default on their debt. That means they won't be able to pay those promised coupon payment, right? So if you were that bond investor, now you are suffering from a major financial loss because the bond issuer has defaulted on their debt. So this type of risk is called a credit risk. So corporations like Disney, right, they can borrow money by issuing bonds. But there's another way for corporations to raise money or raise a fund to finance their business expansion. So if Disney needs 10 billion US dollars, right, to build a new theme park in Orlando or maybe in Tampa Bay, right? So Disney can borrow money by issuing bonds. But there's another way for corporations to raise funds. Corporations can also raise money by what? By selling stocks. What are stocks? Stocks represent ownership of that corporation. So I'm going to start with a very simple an example to illustrate the origin of stocks. Where are those stocks from for those corporations? Okay, a company, I'm going to use a very simple, maybe to some degree unrealistic, to give you a quick walkthrough of stocks. Okay, so there are so many so-called startups in the Silicon Valley, right, in the high-tech industry. Here, so many beginning like tech companies, right? Small tech company in the Silicon Valley, Palo Alto, Mountain View, Sunnyvale, this area. Okay, suppose you just started your small business, right? And it is called a private company. Because this company is owned by its founder, could be you, right? And right now, so for example, what do you have for a company? You have a piece of land. And this piece of land has a market value. So for example, 1 million US dollars. You own a piece of land. And also you own the office building for business. And your office building's market value is current market value is, so for example, 9 million US dollars. Also, suppose you are running a high-tech company and you own some patents. And your patents now, their market value is equal to 10 million US dollars, right? So, okay, suppose, for example, now you have one piece of land for business, you have one office building, and you own some patents. So together, so what's the total market value of your company right now? So we have 1 million plus 9 million plus 10 million. So your company now is worth how much money? 20 million US dollars. Okay. Suppose you want to expand your business. Your business is very successful, right? You need to buy another piece of land so you can build another office building, or you can rent another office building. And you want to hire more workers, or you want to expand to the international market. So you need money. You want to borrow, you want to raise money to finance your business expansion. So one way for you to do this through issuing bonds. But since you're a new company, a startup company, right? So probably it may be difficult for you to borrow money by issuing bonds. But there's another way. You can borrow money by what? By selling the ownership of your business. So how do you sell the ownership of your business? You can sell or issue stocks. And to raise money, raise funds by issuing stocks, right? So in general, you need the guidance from the so-called investment bank. What's an investment bank? The investment bank is different from a commercial bank. Remember, what's a commercial bank? Wells Fargo. A commercial bank is a bank, right, where you can just walk in, you can open a checking savings account, right? You can get an auto loan, you can get a personal loan, you can get a mortgage. The investment bank. So, for example, the most famous investment bank in the world, right, is Goldman Sachs. So this is the homepage of Goldman Sachs, right? So here, let me expand this menu. Seems like Goldman Sachs does not offer checking savings account service like Wells Fargo, right? Why? Because Goldman Sachs, even though it is still a bank, but it's an investment bank, not a commercial bank. So you can see what we do here, right? Investment banks, right? They help business, right, to raise money by issuing stocks. This process is called IPO service, initial public offering. So your small business here, right, you want to raise money by selling ownership. So you need to hire an investment banker to help you to go through this process. So you need to hire advisor or consultant from the investment bank. So for example, Goldman Sachs, right? Okay, so this investment banker or consultant, this person is going to have an estimate of the current value of your business. So now, right now, your company is privately owned by you, and your business now is valued at $20 million, right? So this is called the total equity of your business right now. So your business now, right now, is worth 20 million US dollars. You have land value, also capital value, and also you own some patents, right? Okay, so if you want to raise money by selling ownership, right? So the investment banker or the consultant may recommend dividing the total ownership or the total equity of a business, $20 million, right, into shares of stocks. So, for example, if you the consultant recommends to divide the total equity of a business into 1 million shares of stocks, this 1 million shares of stocks together they represent the entire equity or the entire ownership of your business. So then what's the market value or what's the price for each share of stock? At this stage, this is equal to here, right now, the total value of your business, right? 20 million US dollars. Divided by how many shares of stocks you are going to issue in the stock market, 1 million shares. And what's the answer here? So right now, the price for your stock is $20 per share, right? So the investment banker or consultant is going to help you go through this entire process and to help you sell stocks in the stock market for the first time. Suppose if you sell 1 million shares, right, of your stocks, and then you are going to raise how much money? $20 million. But in this case, essentially, you have sold out everything of your business, right? But in exchange, you have raised $20 million in the stock market. So that's the basic idea for stock. So overall, stock represents ownership of the business. But once your stocks are available or once your stocks are traded in the stock market, your company, this company has become a so-called public company or public corporation. Why? Because the ownership, which is represented by shared stocks, right, are freely, in general, freely traded in the stock market. So most people, they can either buy or sell the ownership of this corporation. So that's why this company has turned from being private to being public.